And we're live.
Good morning, guys. We are ready to start. Thank you very much for your patience. Just a couple of points of interest. So it's the first time that we not just have a Zoom session together, but that we try to, I think not just try, that we are successfully streaming on YouTube as well. This is going to be also our setup for the corporate finance course. So the idea of today is not just to give you an accounting refresher. The idea is also for us to figure out our final setup so that when the corporate finance course starts, everything will work flawlessly. We're a couple of minutes over time. In the future, this will be on time. Thanks for your patience. A couple of things. So you can follow in Zoom. If you are on Zoom with me and you have a question, it's very easy. Unmute yourself and talk to me like normal people. So you can always interrupt me. Don't feel you have to be extra polite and wait for a natural break in my talking flow. That will not occur. Just interrupt. If you follow the YouTube stream, I would very much like a few of you to do that. I want to test this as well. If you then have questions, obviously you cannot talk to me because you will be just watching YouTube. Please use the live chat. So I have one of the pre-master students with me, Ikamba, made all the way this morning from Utrecht, is in the studio with me, is monitoring the live chat, like 2 meters from me away. If there is a question in the live chat, Ikamba has one job, to immediately interrupt me and basically throw the question at me. So you can interact as if you were in the chat, in the Zoom call with me. Just be aware the YouTube chat, as far as we know, has a lag of about 30 seconds. All right. On the agenda today is, as I've posted in the announcement, is an accounting refresher. Obviously, we are not going to dive into all the dirty details of accounting. I want to make sure that we're all more or less on the same page, meaning that we all know what's a balance sheet, income statement, and cash flow statement, how are they connected, and a couple of interesting things. Like I said before, if you have questions, by all means ask. I think most of you are pre-master students. That means we have not officially met, so I think a brief introduction is in order. My name is Florian. I'm from the glorious finance department at RSM. I teach macroeconomics in the first year Bachelor. I teach, obviously, corporate finance in the second year. Every year I supervise a ton of bachelor theses, obviously finance theses. Every year I supervise about 40 master theses, also finance. And the second thing I do, also for RSM, is executive education. So not just students like you, but really executives that are already working, CEOs, CFOs, people like that need some more specific training. So a lot of what I do is actually revolving around actual executives. And the reason why I want you to know that is, I want that you believe me when I say I'm not going to ever teach you something that's not real life relevant. So since I work a lot with executives, obviously I constantly have a link to actual practitioners, meaning you will never hear any sort of bullshit from me. Everything we discuss has real life relevance. My own research field is capital structure theory, which is very fortunate because half of our corporate finance course is going to be capital structure theory. I always need teaching assistants, I always need research assistants. So if at some point after you're done with your corporate finance course, you want to work for me, for the department, just reach out to me and we chat about this. I thought, since you are all new on campus, very likely you will not know many other people yet, and you will not really know how pre-master students later on perform. So I thought I want to say a couple of things to basically motivate you. And I reached out to my colleague Gabi Helfert. You probably have never heard her name, you probably have never met her. Gabi is actually the executive director, not of one master, but of all of our master programs. And I emailed with her yesterday and asked her, give me statistics on the performance across all the master programs of students like you that have been before pre-master students. I want to tell you guys roughly what performance to expect from yourself. She did not have accurate numbers, but she said it's okay if I quote her literally, and she said this: pre-master students do exceptionally well across all master programs, and they typically, so she said the dropout rate is almost non-existent, and thirdly she said the GPA, once master students graduate that have been pre-master students, their GPA is extremely high. So needless to say, I expect an awesome performance from you. But what I want you to know at this point is you do not need to worry. It is not that you have a huge deficit or anything like this. Typically, if past this prologue, pre-masters perform really well, all right? On our agenda today, as I said, accounting refresher, balance sheet, income statement, cash flow. And on Friday, I want to do a brief refresher of finance content of the first year, just so that when our corporate finance course starts, we are basically ready to go. All right. Did I address everything that currently is on your mind, or are there already questions before we dive into the actual lecture? Is it clear, guys? Any questions?
All clear.
All clear?
Yeah.
Very cool.
The sound of the exit and entering sounds is still on, and it's kind of disrupting. Could you maybe turn it off?
That's a good point. Can we do this already?
We're broadcasting from the browser version, and I can't find the setting over there.
Okay.
Next time we'll use the app. Sorry.
Yes. So that was Elko, my cameraman. Cameraman is an understatement. Our engineer, I should say. The reason why that is, it's only today. The reason is I have not installed Zoom on my work laptop, so I have to use a browser version, and we cannot disable it there. But in the next setting, we will have another laptop where it will work. All right. Let's dive in. I would like to, like I said, balance sheet, income statement, cash flow statement. No bullshitting, no big terms. I want that we all understand the core mechanics. So, starting point is, if you look at a financial statement, tell me please, how do you know that you're looking at the balance sheet? How can you even recognize a balance sheet? Tell me. Don't be shy. Yeah, debit and credit side, it's already too many big words for my taste, but you're absolutely right. A balance sheet has two sides. That's the core of it. We have a left side and a right side. Of course, they're called debit and credit. In the real world, I find it more common that accountants actually really say left side, right side. On the left side of a balance sheet, what do we find? Assets. Yes, very nice. Assets. What do we find on the right side of the balance sheet?
How the assets are funded, or funding of the assets.
Yeah, you already. Yes. On the right side of the balance sheet, we find liabilities and owner's equity. Of course, all of this we will dive in and explain in more detail. So this is my block of assets. I have a little bit of liabilities, and I have some equity. All right. The sum of both sides, this is simply the balance sheet total, the sum of that has to equal the sum of the right side. You already said absolutely correctly, you steal a little bit my punchline. What's the core logic of a balance sheet? It is this. On the left side, we have assets. On the right side, we see, you said it absolutely correctly, how are all these assets financed? Where are the funds for these assets coming from? I want to start today by talking about assets, then we go to the liabilities, to owner's equity, we will look at the income statement, and last but not least, we will finish then with a cash flow statement. Let's talk about the block of assets first. I would like you to tell me what is the simplest definition of the term asset that you can come up with on the spot. When somebody says the word asset, what is he or she actually talking about? What is an asset? Tell me.
Any products like buildings, things like that.
I like what you say. You're correct. It is a correct example. Land, buildings, but there are examples. I'm looking for a general definition. What is an asset?
Like a possession.
Yeah, like a possession. I like it too. Give me.
Investments plus liabilities and extracts like personal, how do you say it, like personal money out of the company.
Yeah, it's all not wrong, but it's too inaccurate for my taste. I think the simplest definition of asset I can think of is this. stuff that belongs to the company, that the company keeps with the idea of generating revenue. But so the core is stuff that belongs to the company, all right? So we have, broadly speaking, two different categories of assets. So we can group them together according to different criteria. So the first thing I want you to remember here is a lot of people get confused about accounting because the same group of assets can be grouped in a completely different way depending on what your grouping criterion is. So the most common thing that you actually see in a balance sheet is that you split assets between current assets and fixed assets. Let me just write it down quickly. So this block here are the current assets. I will explain in a second what that is. And the other block are the so-called fixed assets. Let's talk about that first. Just in case I forget, please remind me in a couple of minutes. I also want to quickly talk a couple of minutes about a different way of grouping assets, tangible assets versus intangible assets, all right? But for our finance course, this split will be much more important. So let's start with the block of current assets first. What is the simplest definition you can think of for the term current asset? What is a current asset? Help me out.
Those are assets which are usually on the book for a period of up to 1 year.
Very nice, man. I like it. Excellent. Really good. You already talk a little bit like an accountant. Assets that are on the book for not more than 1 year. I agree, you're absolutely right, but I said today I don't want any big terms because I want that we all understand what's happening. So let's not hide behind big terms, let's just break it down as simple as we can. I would say a current asset or current assets are these assets that are converted into cash within 1 year or less. Or in even simpler language, what is a current asset? An asset that I will get rid of, that I will sell in some way within 1 year or less. So the split between current and fixed assets has to do with how quickly an asset is converted into cash. It's that simple. There are 3 current assets I need you all to know. Give me a couple of examples. Now I really need examples. Give me a couple of examples for current assets. Tell me.
Cash.
Cash. Officially the position would be called cash and cash equivalents. So,
Receivable.
very nice, man. Account receivables, AR, and think about Albert Heijn, the milk, the meat, the bread. What's that?
Inventory?
Yes. Yes, inventory. That are the 3 current assets, and we will probably not need more. That are the most common assets that you can expect. So, how can I say that these assets are all current assets? I said the definition of a current asset is an asset that is converted into cash within 1 year or less. So cash is already cash. It does not get more liquid. Cash is our benchmark. So cash obviously is a current asset. What about accounts receivables? This is just big accounting language for something that's super easy. Accounts receivables, the position tells us how much money somebody else owes to our firm. So if it says account receivables 100, it means somebody else owes money to us. When does this money have to be repaid? Within less than 1 year. Because if it were more than 1 year, I would not put it into the block of the current assets. So that has to be repaid to us. We will collect the money that is owed to us within 1 year or less. Accounts receivables. And last but not least, inventory. Inventory is, like I said, in the case of Albert Heijn, the milk, the meat, the bread. So it is basically stuff the company holds with the idea of selling it to their customers. So what's in the inventory of a company, let's say like Harley Davidson? What do they have in their inventory? Tell me.
Like motor parts, wheels, stuff like that.
Absolutely. Motorcycles and spare parts, new tires, new brakes, whatever, stuff like that. What is in the inventory of a company like Apple?
Software.
Yeah, software probably as well, but I would say Apple is not most known for being a purveyor of software, right? I would say in the inventory of Apple we have the laptops, the tablets, you know, the iPhones, of course. All right. So now you are students of RSM. We are a company as well, right? What do you find in the inventory of RSM?
That's a good one.
Yeah, I have my moments even at 9:30. What would you say?
I would usually think about students, but you know, it depends on the study. If you're a master student, you can be converted in 1 year to, you know, you can get your diploma in 1 year, and you can become. You know what I'm thinking, kind of?
I know exactly what you're thinking. I like this. A great input. Let's talk about this. The reason why I'm so keen on definitions is exactly this. If you don't know the definition, you're kind of screwed now. I said the definition of a current asset. We are now talking about inventory. The definition is stuff that belongs to the company that they will sell for revenue within 1 year or less. So the question, to basically respond to your input with a counter question, is RSM in the business of selling students? What would, yeah.
In the business for selling places within their courses, I think.
Yeah, so, but to answer the question first, we are not in the business of selling students, right? That is not what we do. So we can already rule out that the inventory of RSM shows students. So what else could it be? If students are not in our inventory, what else is in our inventory then?
You know, if study store is owned by RSM, pencils, things like that, food, the food court.
Yeah, I cannot say you're wrong because you made a very smart legal disclaimer. I don't know if the study store is part of RSM, but if yes, it would be the books. And I cannot say that you're wrong. You're absolutely right. But the study store is not part of RSM. I agree they are on campus. We rent a small sort of office space out to them so that they can operate their business from there. But it is not part of RSM. But you were right. You would be right. If the study store belonged to us, then you could say RSM actually has two operating activities, not just teaching, but also selling books. Then you would be right. The same is true for the second thing you said, the cafeteria. If we would, which is also not the case, but if we, RSM, would operate our own cafeteria, then we would have as a business activity teaching, education, whatever, and selling food. Then indeed the food would be in the inventory. But none of that is the case. We are really, you know, quote unquote, just teaching. What is in our inventory?
Course material?
Course material. Interesting point. Do we sell course material? I think it's very difficult for you to answer that. First of all, because I ask you specifically that it's almost like a trick question, but because you are a little bit misled by the complexity of education. We're just talking about a company that provides a service, right? So if the question, what does RSM have in its inventory, if that's too complex, then just replace it with an easier example. Imagine I had asked you, what is in the inventory of the average hairdresser? What does a hairdresser have in the inventory?
Someone in the YouTube chat says knowledge or a spot in the program.
Knowledge or a spot in the program, also good input, but it's also not the case. And the reason is, broadly speaking, a company has to be one or the other. Either a company has a physical product that they sell, like Apple. They sell laptops and iPhones. Or it is a company like Albert Heijn. They sell physical products, the milk, the meat, the bread. Or like Harley Davidson, the physical product is a motorcycle. But the second kind of company does not have a product, they are service providers. And it is part of a service that it cannot be stored. I always give the same example. If you're really bored in my lecture, you cannot call your hairdresser saying, hey man, please prepare my haircut, I pick it up after class. A service comes into existence only with the help of the customer. Without you, your hairdresser cannot cut your hair. Without you in my class, I cannot provide my service, which is teaching you. So, let me repeat the question and let's try to answer it. What is in the inventory of RSM?
Then we still have people saying teaching lessons, teachers and program, and someone even says maybe experience.
Teaching lessons, experience. Yeah, none of that is true because, as I've said,
Or nothing.
exactly. Who said nothing? Tell me the name.
Moos Janssen.
Moos Janssen. Love it. Very good. You're absolutely right. A service provider has no inventory if it's a true service provider. RSM is a true service provider. We have no inventory. If you were to look at our balance sheet, there would be no inventory. To go back to my hairdresser example, now a hairdresser might actually have an inventory, not because they have the service stored. The service can never be stored, but a hairdresser is not a pure service provider typically. They also will sell physical products like shampoo and hair gel. I mean, obviously I don't know the details about hairdressers, but you know, so then they would have this kind of stuff in the inventory, but the actual, anything that has to do with the activity of cutting hair would not be reflected in the position inventory. A pure service provider has no inventory. Does this make sense, guys?
It does make sense to me, but I still have a question. Like,
Ask.
So what you're actually saying is RSM doesn't have any inventory, but does that count as well for chairs, tables, computers that are under?
Yeah, let's talk about that. It's a very cool input. Thank you, man. What about the chairs, the tables, stuff, the computers, office equipment, stuff like that? Well, you need to ask yourself.
Fixed assets, right?
Say again?
They're fixed assets, right?
You're absolutely right. Yes. That is not in our inventory because we are not IKEA. So if you, I mean, you will not have, as it looks, any lectures on campus. But if you had lectures on campus, let's say with me in the aula, after the lecture you say, I kind of like the chair. It's so nice. I want to buy it. I mean, nobody at RSM will sell you our chairs, no matter how cozy for your ass they may be. You cannot buy our furniture. If you look at my work laptop and you say, hey dude, I kind of like your work laptop, I cannot sell my work laptop to you either, all right? So the office equipment, the chairs, all of this would definitely be on our balance sheet, but it would not be, first of all, it's not a current asset. How can I say it's not a current asset? The idea of our chairs, of our laptops, of our video beamers is not that we want to sell them as quickly as possible. We are not a company that deals in selling furniture and stuff like that. These are fixed assets. So fixed assets are assets that are supposed to stay in the company for more than 1 year, clearly to support the revenue creation. So the land, the building, production machinery, office equipment, all of this, that would all be fixed assets. I have something that's very relevant to me. Sometimes, not just students, but people think about inventory like, okay, I need to remember a chair, a table, a laptop is never a current asset, it's always fixed. And that is wrong. If I am a company, let's say I'm a carpenter, what I do is I manufacture office chairs. However, because I'm a big carpenter company, I have, of course, also offices in which I use office chairs. So then what you would have is, you would see office chairs as fixed assets. That is my own office equipment that my own employees use. But also you would find office chairs in the inventory. Why would that be? Because I'm a carpenter and what I do is I manufacture furniture that I sell. Or think about the company Apple. Apple in the inventory will have a shitload of different laptops. However, Apple also will have laptops that are fixed assets as part of the office equipment. All right? So don't make the mistake of memorizing these are positions that are always fixed, these are positions that are always current. It very much depends on the operating activity of the company. Operating activity of the company is something you will hear me say a lot. Operating activity means what is the main purpose for a company to exist? So think about RSM. Sometimes we actually, that's not a made-up example, that's true. Sometimes RSM indeed sells laptops. So my work laptop is I think depreciated over 2 years. So RSM says, hey dude, we give you a new laptop. After 2 years, we assume it's completely broken and you get a new one. And then I always get an email from our IT department saying, hello Florian, Your laptop is now old and crappy. Do you maybe want to buy it? Classic RSM, do you maybe want to buy it? And I could then purchase it. So you could look at RSM and say, wait a second, how can you say that RSM is a school? They in fact actually do sell laptops. But this is different because the operating activity of RSM is not selling laptops. It is not the main point why we exist as a school, so that we can sell laptops. But sometimes in the course of our education activity, we do sell laptops. So that does not mean that it's a revenue. It does not make our laptops inventory. It would show up in the income statement and as something like maybe other income, or if we sell it for a profit, it would be called gains from the disposal of fixed assets or something like this. Okay? So I don't want that you're confused about this. When you're trying to figure out what is a company's inventory, ask yourself simply what's the main purpose for this company to exist, and whatever product they actually sell in the course of the operating activity, that will very likely be their inventory. Does this make sense, guys?
Yes.
Yeah? All right. Okay, so that were the current assets. Let's talk about fixed assets some more. So fixed assets, as I've already said, are assets that stay in the company for more than 1 year. Give me a couple of examples, just so we have a couple of examples to discuss. Say again? Sorry, that was too quick for me.
Buildings,
Yeah, buildings. Give me more.
machinery, product line, land,
Land. Machinery, you said. Machinery, office equipment. Yes. So all these things have in common that they stay in the firm for more than a year. Why would they? Because that's what the company needs to have in place so that they can operate. So in the case of Albert Heijn supermarket, give me a couple of ideas. Which assets would we expect to find in the balance sheet of Albert Heijn? Which fixed assets? Say again?
Delivery trucks.
Delivery trucks, of course. Very likely they will have delivery trucks. If the delivery trucks are purchased by Albert Heijn, so if Albert Heijn really is the legal owner of the trucks, then yes. If they have just rented trucks, they will not be in the balance sheet. All right? What else will we have in the balance sheet as a fixed asset? In the case of
buildings.
buildings, give me more.
Cash registers.
Warehouses, yes. And of course, basically everything you find in a shop, right? So the fridges, the shelves, the cash registers. Albert Heijn does not sell the cash registers. They need them so that they can do their operating activity, which is selling milk and meat and bread. And for that, they need their cash registers, all right? Okay, so that are the fixed assets. All right, let's talk about how that will look in a real balance sheet. So you look at a real balance sheet, you find your current assets, the specific positions, cash, account receivables, inventory, buildings, land, and so on. And next to that, you will find a number, whatever, 100, 200, something. That is always, of course, in currency units, so in euro, in dollar, and something like that. My question is now on a meta level. The number that you find here, let's look at the position building. Let's say you find a building and the number next to it says 100. The 100, where's that coming from? What does this 100 represent now?
It's the book value, it's the current value that the asset is worth.
You said two things now. We need to unpack what you said. It's the book value, it's what the thing is worth. So I really need to address your input on two levels, all right? Number one, you use the word book value. You're absolutely right, book value. But today I said, let's keep it with technical jargon to the absolute minimum to not make it more complicated than it is. Even though you're absolutely right, it would be called book value. But how? I mean, what does the book value represent? Well, you try to explain in the second sentence, it's what the stuff is worth right now. So if that is the case, then the following statement must be true. If I sell this building right now, will I get 100 euro? Is this what it means?
No.
Yes, you're absolutely right. It does not mean that. And that is a very important distinction. Feel free to make a note. Sometimes during lectures I say, if you want to know more about this, Google the following terms. So if you're very interested in that, and I think you should, then Google book value versus market value. Book value versus market value. And you will find this is an absolute rabbit hole. So if you say, oh well, I just look it up 5 minutes, you can spend theoretically years reading up on that. In the course of corporate finance, we can discuss this some more. For the time being, I want that you understand this is not the same. Let me show you what a book value is. Or let me start differently. Why do I want to talk first about book values? Because we are in Europe, and in Europe we typically use historic cost-based accounting. So that means when you look at values, I should even be more general, the numbers, the currency units in the balance sheet, that will be book values. What is a book value? The book value of an asset is basically historic cost. I will explain in a second in normal language what it means. Historic cost minus accumulated depreciation. That's what a book value is. I know I said myself, let's keep it down with the technical terms. So I need to explain this. What is historic cost? It's just fancy accounting language for however much you yourself, the company, originally paid for that. So in the case of the building, I might have purchased the building, I'm just making stuff up now, the purchase price might have been, let's say, 200 euro. Okay, so that would be historic cost. That's the historic purchase price, backwards looking. And I wrote down minus accumulated depreciation. Unfortunately, we need to talk briefly about depreciation. Can you, in the simplest words, tell me what does it mean when I talk about depreciation? What is depreciation really?
It has something to do with the years. Like, for example, the building gets valued less and less over the years.
Yes, you're absolutely right. You're completely on the right track. Most assets, or I almost want to say all assets with the exception of one, fixed assets, sorry. When we talk depreciation, this is only applicable to fixed assets, all right? Depreciation happens to fixed assets. Depreciation does not happen to current assets. So all these assets have one thing in common, which is they lose value because I use them. So think about a car. If you purchase a new car, no matter if you're a good driver or a bad driver, driving the car, using it as a car means to be used, causes the value of the car to go down. Why? Officially, it would be called physical deterioration. By driving, I will use up parts of the engine, the tires, the brakes. I mean, I smoke a lot. If I have a car, it takes about 2 days and the car is inside. I mean, it's smelling of smoke, right? That would be reflected in a lower value. If after 1 week, me driving a car, I want to sell it, I would certainly not be able to sell it for a price that is higher than what I myself paid. So if I buy a car, if I bought a car for 200 and I have used it for a week and then try to sell it, I would only be able to sell it for less than the 200, right? So this fact of the value of a fixed asset going down because it is being used and more being used up, this is what we call depreciation. So depreciation reflects the reduction in the value, in the book value. So how does it work? So let's say I purchased a car for 200 euro, and let's furthermore say a car has a useful life. I'll explain in a second what that means. A car has a useful life of, let's say, 10 years. That's something that you would look up in the tax law, okay? What does this mean? Useful life is the official term that the accounting law has for the following situation. The accounting law says you buy a new asset, in my example a car, and the useful life is the period of time that you can use it. After the useful life, the value of the car, in my example, will be reduced to 0. And then we as accountants simply say, okay, well, I bought a car for 200 euro. The accounting law tells me after 10 years it's supposed to be worthless, have a value of 0. So we then pretend that the car loses the same amount, the same value every year. That is called linear depreciation. How can I calculate this? It's very easy. The annual depreciation expense, be aware this is an income statement position now, is calculated very simply as purchase price divided by useful life. So in my example, that means we bought the car for 200 euro. We divide it now by the useful life of 10 years, and that means the car will lose how much value each year? Well, 200 divided by 10 is 20 euro. What does this mean now? This means I purchased the car for 200. In the first year, it will show up in my balance sheet here. It will show up here, car, 200. After 1 year, what is the value that it will show? Tell me.
180.
Excellent, 180. The next year it will go down another 20, another 20, another 20, so that after 10 years, the book value here, so historic cost, 200, minus all the accumulated depreciation. Accumulated here, in case you're wondering, what does the term accumulated specifically mean? It just means the depreciation expenses of the previous years that I have been basically collecting. So if after 5 years, I will have collected 5 times the annual depreciation, what will be then the book value? Historic cost 200 minus accumulated depreciation means 5 years in my example have passed times the 20 euro, that's the depreciation expense per year. So that would be 200 minus 100. So in the balance sheet here next to car, you would find a book value of 100 then.
Sophia asked, what
Yeah.
about products that become more valuable over years?
Very cool question, Sophia. The question, what happens to products whose value increases? We don't even, let's maybe do this more generally. What about any asset, not just products? What about any assets? Now we are not, just so you know, we are not in the basics of accounting. I'm happy to answer the question, but this is not basic anymore. This is now intricate, but let's talk about this. But I would, Sophia, if you don't mind, I would like to look at the opposite case first. What about assets that lose value much faster? So I've been once driving with my brother. He was driving, worst experience of my life. And we were driving on the highway and we missed the exit. And I said to my brother, hey dude, you just missed the exit. And my brother stopped on the highway, put in reverse and started driving backwards on the highway. So if you drive like this, the probability that you will be involved in a serious accident, I would say, approaches certainty. So what about this? I bought a car for 200. Based on normal accounting law, a useful life of 10 years is prescribed. But after 1 week, my brother decides to wrap the car around a tree. What then? You cannot then say, well, it goes down in value 20 euro each year. No, my brother trashed the car in one go. What happens then? So then you would do what we call an extraordinary depreciation. So what I've shown you is just the normal depreciation that reflects the normal reduction in value because you use it. If you're such a shitty driver like my brother and you wreck the car totally in year 1, what you would do then is you would not have to do any of this because the car is immediately completely gone and fucked up. So you would then book a depreciation, an extraordinary depreciation with a value of 200 euro. So far, so clear?
Yes.
All right, so let's talk about Sophia's question. I need to give you now a bit of a different example. We need to talk then briefly about real estate. So I'm sure you hear it. I'm officially from Vienna, from Austria, and my family has a couple of houses in Vienna. And I remember when I was a kid, my dad bought an apartment that was next to the rails of a train. So it was very loud. So we were able to buy it for very little money. 10 years later, the city of Vienna decided to build a noise reduction wall. So all of a sudden, the value of the house tripled, simply because it was a quiet house all of a sudden. So if you think about then the balance, my father does not prepare his own balance sheet, but if he had, he would have been in this situation. He would have bought a building for 100, and all of a sudden the value has tripled. That's pretty much Sophia's question. What about assets whose value does not go down but goes up? So this is not difficult, and full disclosure, it depends on where your company is operating, because that will determine which accounting law you have to apply. Is it Austrian accounting law or German or UK or America? So I cannot give now a general answer, but to say something about it, couple of things. No matter which accounting law you use for a position, let's say like real estate, you could not increase the value beyond the original purchase price. Let me show you an example of that. You bought a building for 100. Let's say, I'm just making numbers up now, let's say after 1 year, you have depreciated it by 10. Just normal, use, normal wear and tear. So you bought it for a purchase price of 100. After 1 year, you reduce the value by 1 depreciation expense, in my example 10. So it would show up with a book value of 90 euro. All right. But then somebody builds a noise reduction wall, and the value of the house is estimated to be 200. What then? Originally, the purchase price was 100. This year, the 10 is the normal depreciation expense. This would be logically then the book value, but to use the term now, the market value. So if I ask an expert, what do you estimate would be an informed third party be willing to pay for this? The person says, roughly 200. What do I do then? I can only increase the value of the building up to the purchase price. So I could basically reverse my depreciation expense, the 10, and increase the value back to 100. Why can I not increase it to 200? Because that's really the market price that the expert has determined. I'm not allowed to do that. Accounting law says it's kept at the historic cost, at the purchase price 100. This is not always true. It depends, like I said, on the accounting law that you use. So if you use international accounting law, IAS, IFRS in Europe, United States Generally Accepted Accounting Principles, so US GAAP, there could be exceptions to this. But typically, you would not be allowed to increase beyond purchase price. In case you're wondering why, what's the reason for that? The reason for that is the principle of prudence. You have not sold the building yet. So if you were to change in your balance sheet the book value from 100 to the market value of 200, you're basically pretending that you're richer than you really are at the current moment. As long as you have not sold it, something could still go wrong. Imagine I put the building now in my balance sheet with a value of 200, but because I smoke a lot and I very often fall asleep while smoking, I have to admit, I burn down the house. What then? Then I have destroyed 200. My shareholders have not seen this coming, and they are basically screwed. So the accounting law would not permit that because it's too risky. You have not sold the building yet, and therefore you're not allowed to do this. In the real world, it would show up then with 100. If you really decide to sell it for 200, you sell it for 200, and you will make an accounting profit of 100, right? Because officially it shows up with 100, but you receive 200. The delta, the difference of 100 would be a gain from the disposal of a fixed asset. Sophia, would you say your question is answered? Already 10 minutes ago, huh?
And Ion let's ask, what about the moment you get a car out of the dealer? Once you get out of the gate, you lose 30%. What about that?
Also good question. What about that? You buy a car, the moment you drive it out of the dealership, you're absolutely right, the value has already gone down 30%. So, I mean, it's a fact, I cannot disagree with this. Why is this? I mean, nobody can really say, I mean, just you driving the car for 10 meters out of the dealership, it's not logical to say the car really has lost 30% value. The reason for that is something else. The reason for that is if you try to sell it, you cannot, or the car dealership cannot claim anymore it's a new car. It already had one owner, right? So that means it's more difficult to sell, and the market immediately would say, well, it's not a new car anymore, and therefore minus 30%. I am not, please understand me correctly, I am not making the claim that there's really something wrong with the car that caused the value to go down. It's more of a marketing thing if you think about it. Just the fact that I cannot say it's a new car will have this effect. All right? Okay, so that are the fixed assets. I would suggest we quickly finish the balance sheet and then have a 15-minute break, and then we do income statement and cash flow. So just, I don't know, maybe 10 minutes, 15 minutes more before the break, if that's fine for you. Let's move to the other side. Other side of the balance sheet. No, I have a question first, sorry. Last question about assets. Think about RSM, university, right? We spoke now about the left side balance sheet, current assets, fixed assets. I have a question for you. Imagine you look at the balance sheet of RSM because you try to find me there. Where would I, as a finance professor, show up on the balance sheet of my employer, your university? Where would you find me? Tell me.
Fixed asset?
Fixed asset, be more specific. So you say in the category of fixed assets, but what would the position be called, do you think?
Labor, kind of.
Labor, okay. Different opinions.
Intellectual property, maybe?
Intellectual property, interesting choice. Different opinions.
You will not be on the balance sheet?
Are you asking me or are you telling me?
Telling you.
Yeah, why would you say something as outrageous as this? Are you saying I'm not value creating? Is that it?
Correct.
Human assets?
Human assets. The reason why I'm so keen on definitions is it helps you answer these questions. What is the simplest definition of an asset that you can think of?
Something that a company owns that can generate value. In the long
Yes.
run.
So, I mean, in my view, and certainly in the view of my boss, I do create value. I have that in writing in my appraisal talk. He says, you create value. All right. So,
But you might be an intangible asset.
dude,
Or is it?
I have almost 90 kilos. I'm as tangible as it gets, okay? I make a dent in reality when I enter a room. That's not it. But you said correctly, stuff that belongs to the company. I mean, we can argue if I'm stuff or not, but we cannot argue if the university owns me or not. I am a human, and that means, of course, human rights apply. You cannot own another human being. I as a teacher, do not fulfill the most basic definition of an asset. Sure, I do create value, and yes, I do help the university generate revenue, but I am not stuff that belongs to them. The university has no legal claim over me. Think about a car. In what sense am I different from a car? If you have a car and you are a shitty driver, the car will never say, that's it, I'm fed up with you, I walk out and I'll just get a different owner. The car cannot do this. I can. So the university cannot pretend that they will have me forever, because if I don't feel like it, I could drop my stuff now, walk home, and that's it, right? So I'm a human. You cannot own a human being. So that is the reason. There are other problems, by the way, associated with this. Imagine that there would be some accounting exception that says, yeah, you actually can own a finance person like me. So let's say this problem would be sorted out, but what other problems would immediately pop up? Well, I told you, the numbers that you find in a balance sheet are typically book values. What are book values? We've already established a book value is calculated as purchase price minus useful life. So, what do you think is my purchase price? How would we even try to figure that out?
Your salary, maybe?
Interesting idea. My salary, would you say my monthly salary or my salary for a year? Or
On the balance sheet, I would say for a year. I'm not sure.
yeah, exactly. That's exactly, there's no problem that you're not sure. That's exactly the problem. Because I was never purchased, I was never bought, there is no purchase price. So if you would just say the monthly salary, why only for a month? Why not the yearly salary? I mean, I think it would be more logical than to say, well, it should include all the salaries that this dude will earn until his useful life is over. And then the question would be, what is my useful life? It's not so easy to approach it. You could say, well, let's just look at forecasted retirement age. And the university says, okay, I'm now 41 years old. I mean, looking at the developments now, I probably can retire when I'm, I don't know, 75, something like that. Yeah. So the university might say something like, okay, we can get another 34 years out of this dude. So he has a yearly salary of whatever X, multiplied with the 34 years of his remaining useful life. But that would then miss, of course, another point. I am not a car. If I'm fed up with RSM, I just, quit. So the problem, the second problem is, not only does RSM not own me, they would be unable to figure out a purchase price. And last but not least, they would be unable to figure out a useful life as well. All right? I want to wrap this up with something real life. I mean, this is real life relevant.
Last comment, someone said annual salary.
Annual salary. Yeah, okay, annual salary. We've discussed why should it be the annual salary? Because there's no reason. Why not then monthly? Why not half yearly or for 2 years, right? So you would really need to make an argument, maybe based on historic experience, that RSM says on average, people stay at RSM for 10 years before they quit. I'm now at RSM for 6 years. So they could say on average 10 years, this guy has already served for 6 years, so we will have him another 4 years. Something like that, all right? But there is one group of people that you can actually already now put on the balance sheet. Who is that? Tell me, guys.
That's a good one.
Even I know this, even though I hate the answer, but even I know it. Professional soccer players, football players. If I'm a football club, a soccer club, whatever that is even called, I mean, if you look at newspaper headlines, please help me out because I don't follow that at all, I hate it. But I mean, sometimes I see newspaper headlines, football club, whatever A, has bought player something. Even the wording reflects that. They buy and sell these dudes. They really have a purchase price. And they have a contract duration that says, if I pay 500 million for this one dude, I will get him for whatever, 3 years. So I have a purchase price for these people, and they do have a useful life. If you think football is useful, which I would already contest, but that is already an exception in accounting law, because otherwise a football club would never be able to have a profit. Okay, so they are the football players clearly are assets. So the accounting law is changing slowly, but is already incorporating this exception. And indeed, the university example is a great example that's also being discussed. Because a university without faculty, without teachers, is just a building with a lot of empty chairs, if you think about it. All right? But that is a discussion that is happening right now. Does it make sense, guys?
It does, it does.
Super.
Robert asks, how is this in a zoo with animals?
That's a very good question. To be honest, I have to admit, I can say something about it, but I'm not fully sure. If you would put a gun to my head, dude, you have to prepare the balance sheet of a zoo right now. The best I could do on the spot, I would look up the accounting standards on what is called agricultural property. I hate calling animals agricultural property, but that's the closest accounting standard I can think of. And it's really a specialized standard. I've never in the real world, to be honest, I've never had to apply it because I was always working in banking and looking at banks. So I cannot fully answer it. It's basically, if you type into Google IAS, IFRS, so International Accounting Standards, International Financial Reporting Standards, and agricultural property, you will get the whole paragraph. And I know for a fact it has an example in there for companies that breed chicken, so to later on fried chicken. So that's the closest I would get in answering your question. I think most zoos in the real world are I'm not even sure if they are non-profit organizations. I will look it up, all right? Please also look it up, and if you find it first, let me know.
Mo says, apart from soccer players, isn't it that some artists and influencers can be found on the balance sheet too? They also have value.
Yeah, I think there are all kinds of, like I said before, there are all kinds of changes right now. I don't know about influencers, to be honest. I hate the word and I hate what it represents already. So I don't know about this, but I mean contracts with, let's say, testimonials and stuff like that, that is very likely going to be reflected in some way. So that would show them the contract value, all right? But I don't want to get too sidetracked. That's really accounting specifics. It's so specific that I never in my whole life had to apply it, all right? Let's look at the right side before our break. As I've already said, on the right side of the balance sheet, we find two groups of separate positions. Liabilities, you will find out very quickly in corporate finance, we typically refer to that not as liabilities, we refer to it as debt. That's much more common in finance. Debt and owner's equity. Let's talk about that, both of that briefly, starting with debt. Very similar to the assets, you can also group liabilities, so debt, in different ways. The most important split for finance is this. Broadly speaking, we only need to distinguish between two different kinds of liabilities. They are as follows. We have some liabilities that our firm, has to pay back within 1 year or less. Not surprisingly, these are called either current liabilities or short-term liabilities. And logically, we have long-term liabilities. What's the difference? Current liabilities is money that our firm owes to somebody else, that we have to repay within 1 year or less, whereas long-term liabilities are liabilities that we have to pay back in more than 1 year. I have a brief question. Think about economic intuition behind it. If this is the balance sheet of an average company, who does that company most likely owe its current liabilities to?
Suppliers.
Yeah, very nice, man. Suppliers. Typically, that would be suppliers. So in the case of Albert Heijn, I mean, Albert Heijn is not a farm, right? They don't produce the milk. They don't bake the bread really themselves. They get this supplied from somebody else. So Albert Heijn purchases 1 liter of milk, I'm just making numbers up, for 80 cents. And they sell it then to you and me for €1. So the 80 cents in my example, Albert Heijn has to pay then whoever has produced the milk. Current liabilities. And of course, long-term liabilities. Long-term liabilities that are typically, bank loans, and most important for our upcoming corporate finance course, bonds. I don't want to talk about it today. This is what our corporate finance course will, of course, cover. But if a company needs money, a lot of money, a bank loan very often will not do anymore. Fuck it, I'll show you quickly. I cannot skip it. I want to show you. Think about the following example. Imagine this. Imagine I, at some point, take over the Netherlands. I'm the president, the king, whatever, of the Netherlands. And one of the things I want to do is I want to declare war on some other country. And in order to have my war, I need obviously tanks, fighter planes, bombs, soldiers. I mean, I need a lot of, infrastructure because I want to have a big war. So I somehow need to finance this. I'm just making stuff up now. So let's say in order to finance my war, I need 100 billion euro. Obviously, if I would go to a normal bank, ABN AMRO, ING and so on, and I would say, hey guys, it's me, the new king of the Netherlands. You have heard about my war effort. I'm looking for a loan, 100 billion euro. The problem will be immediate. Not that the banks don't want to finance wars. I mean, Google bank involvement in Second World War, for example, that's not the problem. The problem is no bank has this amount of money to give me that loan. So how can I deal with that in the real world? Well, in the real world, you would not be able to raise this amount of money in the form of one bank loan, and therefore you would break it down into smaller portions. So look at this. I need 100 billion, so I could say 1 billion, I print 1 billion times this here. 100 euro, 2%, 10 years. So I print 100 of those. And this is a bond. What it says, 100 euro at 2%, 10 years. What is this now? This is a bond. This is indeed a bond. And it works like this. I print 1 billion of those certificates, basically. If you say, oh, that looks promising, 2%, the current interest rate, by the way, is 0%. So you get 2% more from me than from anybody else. So you can give me 100 euro and I will give you back one of these. What is this now? You have given me 100 euro. So that's the loan I'm taking out from you. You, by paying the 100 to me, are giving me a loan at 2%. When will I repay it? After 10 years, including, of course, the interest rate. I mean, even though you might be poor students, you have 100 euro. Everyone has 100 euro. So even though one bank alone would never be able to raise 100 billion, in this way I can, because I break down the huge loan that I need into a lot, 1 billion, of very small loans. So please maybe make a note of that. When you read anywhere, and in the corporate finance book, and in our lectures you will hear this often, when somebody says, I'm selling bonds. Selling bonds translates in normal language into, I am taking out a loan. If this company says, we need 100 billion, and they say, let's sell bonds, this is what they mean. They mean, let's sell bonds. This is just a big loan broken down into many small units, because the money in every economy is not with the banks or the insurances. It's certainly not with the government. The money in an economy is usually with the people, you and me, not because we are so rich, but because we are so many. Is the logic clear, guys? Does this make sense?
May I ask something?
Yeah, of course.
If you say that, for example, I am selling bonds, does it mean that I am taking the loan, or I am providing someone else with part of the loan?
Good question. We have to be a bit careful about the context. So if a company says, we are selling bonds, very likely they mean what I've just described. They want to raise a lot of money in that way. So, but it's also, of course, possible, let's say you as a private individual, you see a company is selling bonds in that way. You think it's a good investment, so you buy their bond, like in my example, for 100 euro. But then 1 month later you say, well, I actually need the money. I don't want to wait 10 years till I get it back. I need it now. And then you sell your bond to some other interested investor. You would also then say, I'm selling a bond, but you then just mean you are selling then basically this bond certificate that you have to another bondholder. That does not mean that you are then taking out a loan, right? So a company that raises or attempts to raise money in this way would say, let's sell bonds. Or if you want to be more professional in your wording, the company officially would say, we are issuing a bond. All right? It's not just selling, we are issuing that. You as a private bondholder, you have bought the bonds of my company. Later on, you want to get out of the investment, you sell it to somebody else. You can say I sell the bond, but you could not say that you're issuing a bond. So that would be then the difference in wording.
And the 2% paid every year.
Yeah?
Is the 2%, is it going to be paid every year or only at year 10?
No, that's going way too far. We have bonds on our agenda in corporate finance. To be honest, this is an example, and it's not. I have not specified it well enough to answer that question. So that is something that we would have discussed in more detail. There are many different kinds of bonds. So just to give you a couple of examples, what parameters can fluctuate. So in my example here, I said 2%. So first of all, typically that would really be the interest rate that is applied each year, all right? But then the question is, when do the interest payments occur? Are they paid monthly? It's most common to pay semi-annually, so that you get 2 payments per year, every 6 months. It could also be a bond that is called a zero coupon. Zero coupon. In the real world, we only call them zeros, basically, or plain vanilla bonds. They are called zero coupons because they do not pay any interest income to you as a bondholder during the life of the bond, and you get all the interest income only at the last day of the 10 years. That could be a zero. There could be bonds that do not have an interest rate at all here, that do not have a fixed interest rate here. They have maybe a floating interest rate. That's what it's called, floating. So then you would find something like maybe Euribor, I explain in a second, Euribor plus 1%. What does this mean? Euribor is an acronym. It is short for, let me show you, European Interbank Offered Rate. So it's an interest rate in itself. It's the interest rate that is applied when one bank borrows money from another bank within Europe. That's the Euribor. So you could buy a bond that says, what is the interest rate that you get actually? Whatever the Euribor is moving up and down, of course, plus 1%. So then you don't know exactly how much you get. If you expect the interest rate to go up a lot in the future, now this might be very handy. If the Euribor, I'm just making stuff up, would go up to, it's crazy, but let's say 10%, then you would earn on this 11%. Think about this. But of course, downside risk, if the interest rate drops to 0, as it is now, you only get 1%. So long story short, I don't want to talk too much about the different kinds of bonds, because there are so many different kinds that we would really need more specification, all right?
Final question.
Ask.
What do you think about the Euro Corona bonds the Union wants to issue?
Yeah, what do I think about Corona bonds the European Union want to issue? So it underlines what I've initially described. Why would a country issue bonds anyway? Because they need money, so much money that they cannot simply borrow it from a bank. So that's the reason why a country would issue a bond. By the way, my example before with the war, that is not because I wanted to say something funny. That's how bonds have really developed. Historically, they were really called war bonds. All right? Why would the European Union do this now? Because the European Union has to recognize that the corona pandemic has absolutely wrecked the economy worldwide. So we are in a depression right now. What does this mean? Well, there are a couple of consequences. Consumption is down. Consumption by people like you and me. Because we cannot go to restaurants. There are no cinemas. There is no tourism. So basically, we, the people, spend much less money, and that has ripple effects across the economy. So that means there is a lot of money missing in the economy. And the European Union says, okay, what can we do to basically foster and increase economic growth, pump money in the economy? But how? Well, they need to raise money and then distribute it among basically the different participants of the economy. So some of that will go into probably an increased unemployment benefits, because if you only get 1,000 euro unemployment benefits per year, per month, you obviously can spend less as opposed to if you get unemployment benefits of 1,500. So the idea right now, to get out of the depression is to put more money in the pocket of people, because then they will spend more, which puts more money in the pocket of companies. If companies have more money, they will invest more. If more is invested, more is produced, more is consumed, and we basically get an upward cycle. So that's the idea. Why does the European Union want to issue bonds for that? Because we are talking about a lot of money. That's the only way they can do this. What else could they do? They cannot do this with a bank loan because no bank has enough money for that. So bonds is basically the only tool that is left for that.
And why do people buy bonds with negative interest rates?
I would say, I love the question, why do people buy bonds with negative interest rates? I would like to reserve these conversations for our actual corporate finance course, all right? That's going a bit too far. On the agenda is today a brief accounting recap. And all of a sudden, we are already financing wars here, okay? So I'm happy about the questions, don't get me wrong, but this is really course content, all right?
Then I have a question about the liability side
Yeah.
of the balance sheet. When you obtain a loan, do you account for interest payments in the liabilities?
When you account for a loan,
When you obtain a loan,
Yeah.
do you account for the interest payments in the liabilities?
in the liabilities, yeah. So I said before, we split liabilities, we group them current and long term. Give you an example. So I bought a house, I have a house in Rotterdam, and I think it's a 20-year mortgage. If I ask you now, based on everything I've told you, the 20-year mortgage, is that a current liability or is it a long-term liability? What would you say?
Long term?
No. It's also not short term, it's both. Because the moment I get a loan, I have a current component. So all the payments that I have to pay to whatever, ABN AMRO, ING, Rabobank, within the next year. But it's a 25 or 20-year long mortgage. So that means most of my outstanding loan is long term. I have to pay it in more than a year. But a part of that is the current portion. So you can really see this. You would have then here, even if it's only one loan, a current portion of the loan and the long-term portion of the loan. And interest expenses, so the interest component on that, you would recognize not in the balance sheet, it would be recognized in the income statement. It would really be an expense minus interest expenses. Let's talk briefly about equity and then go into our break. This here is the whole block. This is my equity block. It's officially called owner's equity. What is that? So a company needs to have assets in place on the left side of the balance sheet so that they can operate and earn revenue. How do they finance this? They only have broadly speaking, two choices. Either borrow the money, so some sort of liability, some sort of debt, or it's the company's own money. So let's talk briefly how a company can have its own money. The process for that, I'm sure you have heard this many times. This process would be called IPO, Initial Public Offering. It means a company decides to become a publicly listed firm. So let's say at the very beginning a company says, in order to operate, we need assets in place of, let's say they will cost 100. So the company somehow needs to finance the 100. If it's a new company, they might not be able to get a bank loan or they might not want to take out a bank loan. So they can then try to persuade potential investors, please give us money. So if the company wants in the course of their IPO to raise 100, whatever euro, could be 100 million, doesn't matter. What could they do? They could basically issue 100 of those things. This is a stock or a share. It's the same thing. Stock and share are the same things. There's no difference in meaning. So what does that mean? Well, if you give me 1 euro, I will give you back one of those. And I do this 100 times. I sell one of my stocks to you and to 99 other people. Everyone has to pay 1 euro in order to get this. If I sell 100 of them, I will obviously raise 100 times the nominal value of one, which is 100 euro. Then I have 100 euro cash, and my company can really purchase whatever it is that they want. How would this here be reflected in the balance sheet? The position, so in order to operate the logic of our balance sheet, we need two equity positions. This is the most important one. It's called common stock. Common stock. In my example, we would have, after our IPO, we would have a common stock position now of 100 euro. If next year we need some more money because our business is going so well, we want to expand, no problem. I print another 100 of those and sell them again. And then this position would go up. It would not be called then, by the way, IPO anymore. IPO is really short for initial public offering. Only when a previously private company sells their stocks for the first time is it called IPO. Otherwise, if a company like Apple, they issue stocks every year, then this process would be referred to as an SPO. An SPO is logically a similar process. It is short for seasoned public offering. It still means the company wants to raise more equity and sell some more stocks. What is the difference between liabilities, so debt, and equity? It's very simple. Just look at my examples. This was an example of a bond. This is an example of a stock. The differences are very clear. Number one, a stock does not pay an interest rate at all. You're not a bondholder. If you buy this from me, you're a shareholder. And it has no maturity. That means I will never repay this to you. My question to you now is, who would buy that? I just told you a bond pays an interest rate and you know when you get the nominal amount back. And I just said for stocks, this is not the case at all. So tell me, why would anyone want a stock?
Investors seek to make a profit of selling the stock.
Yeah, what you're describing is really pure speculation. Today I buy a stock for 100. Tomorrow it might be traded for 110. If I sell it tomorrow, then the delta, the difference of 10 is a sort of profit.
Yeah.
Sure.
Also for dividends.
Yeah, for dividends. So there is more to it. If you buy one of my shares, you are a shareholder, and a shareholder owns a part of the company. You literally, if you buy a share of Apple, you literally own a part of Apple. It's a very small part because there are so many stocks outstanding, but you do own a part. That means you also have the right to go to the annual shareholder meeting and cast your vote. So if imagine Apple would say, yeah, laptops and iPhones, that's kind of boring. Let's produce assault rifles from now on. You as a shareholder have the right to vote on that. That cannot simply happen that the company changes completely who they want to be and not ask the owner's opinion. So you would have a voting right. And indeed, if the company makes very high profits, you as an owner are entitled to receive this. So let's say you own 50% of all the shares of Apple, you're entitled then to receive 50% of all the profits of Apple. So even though you don't get an interest rate and there is no official maturity when the amount of money that you put in will be repaid, if it's a company and you are convinced the company has a good business model and they will do well in the future, you don't want to speculate with the stock. You don't want to sell the stock later on. You want to own it so that you can participate in the future profits the company will make. All right? Does this make sense, guys?
Yes, but I do have a question.
Ask.
The shares.
Ask. Sure.
How do they calculate actually after the first round, like 5 years, how much the share is representing the owning spread, percentage? For example, if one share is 1% and Apple launches again other stocks, does that affect your ownership?
Yes.
And how much?
I think that are great questions, but clearly we are not talking basics accounting anymore. If you want an answer to your question, I can help you out. Join the corporate finance course that starts very soon officially. That's exactly what we will do, all right? So everything, determining how many stocks are outstanding, how does the return on investment change for existing shareholders if the company later issues more shares. This is exactly what the course is going to be about, all right? Guys, I suggest we have a brief break. We're a little bit over time. I hope you forgive me. I mean, I don't care, to be honest. I want to discuss after the break income statement and cash flow statement. That goes a little bit quicker. But yeah, I would say let's have a 10-minute break. And then we try to finalize the income statement and the cash flow statement for today. We will meet again, of course, on Friday and do then the basics of finance. Is that all right?
Sure.
Super, guys. I see you in 10 minutes then. Guys, welcome back. Thank you for quickly responding in the WhatsApp chat. I was just curious if that works for you, because you have to picture, this is not our official course yet. Once the course starts, you will have 2 lectures per week with me and 1 workshop with my colleague Celine. So you have 3 sessions with us over 7 weeks. So that's why we are tinkering with the setup until we think it's perfect. One feedback that you gave is, when Ikamba reads the questions that are asked in the chat, you cannot hear this, and the reason is she had no microphone, and Elko already fixed it, so Ikamba has now a microphone, so that should be much, much better. All right? Let's not waste more time. Let's hop in. As you've seen, I have cleaned up here a little bit. We still need the balance sheet, but I want to move now into the income statement. The income statement is, of course, also referred to as P&L, profit or loss account, and I'm simplifying a bit. I want to drive home the mechanic of it. We don't need to look at all the positions. We have plenty of time for that in the actual course. I want that you understand the general mechanic. So in the income statement, we don't have 2 sides. It's basically one long calculation. And the first position is typically revenue, also referred to as sales. It's the same thing. What is revenue or sales? It's basically the income a company generates from its operating activity. So from providing its service or selling its product. So logically, you don't have to remember that, but logically this is calculated as quantity of product sold or service provided multiplied with the sales price. So this is what you would find here. I have a question. If RSM sells my old laptop for 50 euro. Will the 50 euro show up in the revenue, in the income statement of RSM as revenue? Yes or no?
I think so.
You think so? Yeah. Explain. Why?
Well, eventually they did bought the laptop for an amount of money and they are selling it now so that they can improve their losses.
Yeah, I mean, I see your logic, but again, we need to think about the definition. Revenue is the income that a company generates in the course of its operating activity from providing its service or selling its product. Is the operating activity of RSM selling laptops?
No.
Exactly. That's why it is not revenue. So this is really only from the actual operating activity. So in the case of RSM, this would reflect probably mostly 2 things. The tuition fee that you guys pay and the subsidies that we get for each student from the government. If we were to sell an old laptop or if we were to sell a building or old office equipment, anything like that, it would show up in the income statement, but it would never be called revenue. It would be much lower somewhere here, and it would be called other income, something like that, okay? The reason why you have to split it is it would mislead your investors. Because imagine a year in which RSM sells all the laptops, the campus, all the buildings, everything, and they would imagine, it's wrong, but imagine RSM would record all of that as revenue. You as an investor look then at the income statement and you would think that's the best school ever. They have so much revenue, when in fact you must realize this is only a one-time thing. We can only sell the campus once and then it's gone. So that would be grossly misleading. So this should only show the income that you generate from providing your product or providing your service or selling your product in the course of your operating activity. And again, operating activity means what is the purpose of this company? Why does it exist anyway? We, RSM, do not exist to sell laptops. We might sell laptops sometimes, but it's not our purpose of existence. Is this distinction clear, guys?
Yes.
Perfect. So also, what I said before about the inventory is still true here. You cannot then simply try to memorize, okay, selling laptops is never revenue. If Apple sells a laptop, it is of course revenue because that is the whole point why Apple exists, all right? So revenue, and then we typically in the income statement have minus all kinds of expenses.
I have to interrupt.
Yeah, interrupt.
Elena had a question. She feels like the balance sheet part wasn't finished yet. She asked because there are two squares.
Yes.
You have common stock and then the second square.
Perfect. Say no more. Elena, you're absolutely right. I also feel that something is still missing here. The reason why I have not addressed this is I need the income statement because this is the position through which the balance sheet is connected to the income statement. So I have not forgotten about it. This is something where we are going now, right now, all right? 2 minutes more patience. So,
Okay, thank you.
of course. So we have revenue minus expenses. I mean, just to have a couple of examples. So an expense that you see very often is COGS. COGS is short for costs of goods sold. Either call it costs of goods sold or call it COGS. It's always weird when somebody says COGS. Don't say this in meetings. It's always awkward, okay? So that would be, yeah?
What was it?
It's COGS, COGS, that is short for costs of goods sold. So, just to give you an example, because it sounds so abstract, what is cost of goods sold? I give you an example. Albert Heijn sells milk to me for €1. So the moment I go to Albert Heijn, the Kassameische takes the liter of milk and pulls it over the beep beep. The moment this happens, I have to pay €1. In the income statement, Albert Heijn will immediately recognize €1 revenue because they have handed over their product to me. So the sales price is immediately booked. However, Albert Heijn did not produce the milk themselves. They bought it from let's say, from a farm for 80 cents. Where would the 80 cent be recorded? The 80 cent are the cost of goods sold. So we would see revenue €1 minus 0.80 cents cost of goods sold. The difference here would be called then gross profit. So far, so clear. That's what cost of goods sold are, all right? Then, of course, you have here all your other operating expenses, salaries and stuff like that. One expense we already discussed in more detail today, the annual depreciation expense. But like I said, I don't even wanna dig in too much here. I want that you understand the company provides their product or sells their service. The income generated is called revenue, and we have all kinds of expenses. So let's briefly talk what an expense is. Imagine I purchase a car for 100. So I hand over 100 and the car dealer gives me back a car. That is not an expense because a car is an asset. In my example, the idea would be to use this as my company car, so it will stay in my company for more than 1 year. I would not book anything in the income statement. What would happen if I were to buy a car for 100? Cash would go down by 100 and a fixed asset somewhere here called car would go up by 100. So the balance sheet total would not change at all. Nothing would happen here and nothing would happen here. If later on then I deduct the depreciation expense, that would be recorded as a depreciation expense here. How does it work if I don't buy a car, but if I rent a car? Well, if I have rented it, I'm not the legal owner of the car, so it does not show up as an asset, of course. It would not cause any change here. So where would it pop up? It would show up as an expense called rent expense. It's that simple. All right? So
I have a question. Can
ask.
I interrupt?
Yeah, of course.
It's a bit different. What if Erasmus is the owner of like a foundation or whatever, and how does the money from there, does it come back on the balance sheet from Erasmus if it's the main holding, let's say, or?
Well, I'm not sure I understand the question. What exactly?
So Erasmus is like a non-profit, how would you call it?
Yeah, correct.
Okay, but maybe it's also owner of foundations for, let's say, athletes or other trust funds or whatever.
All right.
Does the money go up in the balance sheet of Erasmus?
The money that the foundation holds.
Yeah, Yes.
I see what you mean. Well, so first of all, that would be all regulated in special accounting standards. So that's not general accounting anymore. That is then account. There's a bit like this, the question, I'm running a zoo. How do I officially account for the gorilla I have in my zoo, let's say? Okay, that's really weirdly specific. But in general, if a company owns another company, so has a stake as a majority shareholder, or what you described as some sort of foundation, that would be some sort of probably a fixed asset, and it would show up here, a stake in another company, roughly.
Okay.
All right?
All right, thank you.
So in the income statement, I mean, obviously in the real world, we have then several in-between results, but it still does not change the general logic. We have revenue minus all kind of expenses. There can be, as I already hinted at, there can also be other, sort of income positions like other income or interest income. But at the end of the day, big line, and we sum this up, and the result that we get is called profit before tax. So this would be some number, I'm just making stuff up, 100. Then we have minus the corporate tax, let's say it's 25%. So that means you have to pay a tax of 25% of which number? Well, of the profit before tax. So 25% of 100 is 25 euro minus 25, and that would give us a profit after tax. Profit after tax, also of course, and more commonly referred to as net income, bam, of 75 euro. All right? So this would be a profit now. And this is now key. Whatever patience and focus you have left, spend it now. A lot of people are kind of okay with a balance sheet and are kind of okay with an income statement, but they don't know how they are connected. And my view is, if you don't know how they are connected, you do not understand it at all. They are connected, and this is now coming back to the reminder of Elena. What's happening here? What is this weird thing? This is called retained earnings. Retained earnings. I'll explain in a second more. Retained earnings. As you see graphically, it is part of the owner's equity. It's the second important position we have here. Why is it relevant? Or let me start differently. What are retained earnings? Profits from the past that stayed within the company. So how is the income statement connected to the balance sheet? Like this. At the end of the year, the net income or net loss is moved into the equity, to be more specific, into the position retained earnings. So if my company has a profit, what will the effect on equity be? Will it go up, remain the same, or go down? Tell me.
If your company has a profit, I just guess that equity would go up.
Yeah, you're absolutely right. If I have a profit, like in my example here, 75, it is moved into the retained earnings. So clearly my equity grows by 75, right? If I have a loss, it would be moved into the retained earnings as well, and it would reduce my equity by the same amount. That's how that works. Sometimes students, not only students, just all kinds of people say, but I don't understand. Pay attention now. Have a look at this. This is really key. Have a look at this. I said before, the left side of the balance sheet shows us which kind of assets a company owns. So all the stuff that belongs to the company that they need in order to earn revenue. And on the right side of the balance sheet, we can see how all these assets were basically financed. Did the company borrow money, so liabilities or debt, or is it the company's own money, so owner's equity? If I say now, okay, profits at the end of the year are moved into the equity, the most obvious question we have to briefly address is, how is it then possible that the balance sheet sides always match? This always has to be equal. There is no exception to this. Left side must equal the right side. How is that possible? And I think the best way would be if I just show you in a very quick numeric example. So I just make this up as we go along. I just get rid of the numbers and show you. have a look at this. So let's pretend we start with a balance sheet total. I don't even need the specific values. Let's say at the beginning, our balance sheet total on the left side is 100, and on the right side, it's 100. And one of the reasons is we have a building here that's just part of the 100 with a book value of 10. Okay? And just to keep things simple, let's say the building originally we purchased for 100. That was the historic purchase price. And it had a useful life of 10 years. And we are in the last year. So each year, the annual depreciation expense was 10 euro. We have already depreciated it over 9 years. That's why we have only 10 left here. Brief question between, is everyone still on board? Is the setting clear?
Yes.
Nice.
Yes, thank you.
Super, okay. So what happens now when I book the last depreciation? Well, so first I need the building to disappear here, because once I depreciate it, the book value should be 0. It's gone. So how does that play out? Step 1 would be that I book the depreciation expense here. It's an expense, annual depreciation expense 10. Let's say everything else in the income statement, let's just pretend everything else is 0. I have no revenue, nothing. So just to keep it simple. So no revenue, nothing else. I only have one depreciation expense of 10 euro. What will be the final result? I will end up with a negative net income, so with a loss of 10 euro minus 10. What happens then? So the building will disappear. That means my balance sheet total is not 100 anymore, but it's only 90. Crap, I have a delta now here of 10. What happens? Well, that's why the connection income statement to balance sheet matters so much. At the end of the year, the profit and losses, doesn't matter, are moved into the equity, into the retained earnings. So my retained earnings will go down by 10 because of this here, reducing also the right side of my balance sheet by 10. Boom, and I'm balanced again. Does this make sense, guys?
Yes.
Yeah? Is it really clear to everyone?
So your loss in assets is always equal to your net income.
Oh, hi doggy. No, I would not say it like this. I would say the left side and the right side of the balance sheet always must be equal, no exception whatsoever. And how we can balance it is through the connection of the income statement to the balance sheet in the block equity, to be more specific, in the retained earnings. Okay, in this example it was very easy because I assumed everything else is not changing at all. So I only had this one expense here, but the general logic holds. Whatever profits or losses we have are moved into the retained earnings, so into the equity block. And through this connection, we have left side, right side always balanced. You will see plenty of examples during the corporate finance course. For the time being, if you only remember one thing about this, then I want that you remember the income statement is connected to the balance sheet via the position net income retained earnings. This link here, the red arrow, that's key. Okay?
Could I ask something else?
Of course.
I lost the part about what you would do when you lease, for example, a car.
Mm-hmm.
And just wondering, is that in the expenses part?
Yes. Okay, let's look at a leasing example, just to keep things simple. It's actually a good idea to do this. So let's say I don't want to buy a car, I only rent it. Leasing is just finance blah blah for renting. There's no difference. Leasing is renting. So we rent the car. The car will never show up on the balance sheet because we have only rented it. We are not the legal owner, so it does not fulfill the definition of asset. Okay, so how does that work? We rent a car. Let's say we rent the car also for 10 euro per year. How will that play out? Again, I just reset our balance sheet, so an income statement, so we can start over. Have a look at this. So now we have car rent, 10 euro per year. This is now our new example. What will happen? The logical steps. I have to pay. Let's say I rent the car from you, I have to pay for that. So I have to give you 10 euro cash. What is the first thing that will happen? Cash, here, cash will go down by 10 euro, minus 10. That's the rent I pay to you. Whatever our balance sheet total was before, after I paid the rent, I have 10 euro less cash. And my left side of the balance sheet, initially, let's say it was 100. After I paid this, it will go down to 90 because I paid the rent in cash. Again, we are not balanced. How do we deal with this now? Well, rent is an expense. If I give you 10 euro, I don't have a reduction in cash and at the same time increase an asset car here by 10 because I have not bought it for 10. I'm only renting it. So that means I need to record rent expense. It's an expense that's really called rent expense. Rent expense, how much? 10 euro. If nothing else again happens, I will end up with a loss of 10 euro. How does my balance sheet now balance? Again, through the connection of income statement to balance sheet. At the end of the year, this is moved into the retained earnings, reducing my equity by the rent expense of 10, which basically is then also a loss, goes into the equity, and the right side of the balance sheet also decreases to 90. Is your question answered, would you say?
Yes, I was just wondering, maybe that's a dumb question, but doesn't the text mess it up?
Well, does the text not mess it up? Not really. It just makes it a little bit more complex in my explanation, but no, it doesn't mess it up. So you only pay a corporate tax on actual profits. So the moment you have a negative number here, you don't pay taxes anyway. And if you have a tax, let's say you have a profit of 100, then you have to pay 25% taxes on that. That gives you then a profit after tax of plus 75. Don't forget, this is also, so the 75 would go here, increasing the equity by 75. How will that be balanced? Well, the tax I also have to pay in cash, right? It would reduce my cash by 25. I'm always balanced.
Oh, okay, thank you.
Yeah?
I have another question.
Ask.
It's related to the income statement because you deducted both the depreciation and the leasing expenses next to the COGS. But isn't it usually always deducted from the gross revenue?
Yes. So I did not deduct it. No. This is a misunderstanding. I have a stylized income statement here that basically only shows two positions, revenue minus all expenses. You're absolutely right. So first of all, the income statement is a list. So every expense would be a separate line. So obviously the rent expense would not be next to the cost of goods sold. That would happen further down along the income statement. I'm operating here with a stylized income statement just to demonstrate the connections easily. We will, already in week 1 of corporate finance, we will have real income statements, of course. So it's then easy to point out where the rent expense will be. For the time being, I want to focus only on the mechanics. Okay? Okay, guys. I mean, we are already quite a lot over time. I suggest the following. How about we stop here for the day, and we start on Friday, our Friday 11 o'clock session with that just takes a couple of minutes cash flow statement. And then dive into first year finance, net present value, capital asset pricing model, and a bit of portfolio theory.
Sounds good.
Yeah? Yeah? Then we can stick a little bit to our schedule. Guys, before we stop, several things. So first of all, thanks for attending this early. That's really great of you. I think it's also really cool that you're so interactive. I mean, this is the first lecture we have. I mean, when I picture the whole finance course like this, I think this can really work very, very well. So thanks for that. That's amazing. I will, if you don't mind, just brief background. This took me half a year to work with our legal team and the legal team of YouTube to get the permission to attempt this. So obviously, I would very much like to send you a brief survey. Basically, it will only be having two parts. An open box for any kind of feedback you might have whatever you want to say, I would love to hear it. And show important people so that they, allow us to continue like this. And secondly, I have basically one question that I want to ask you in writing so that I can show this to let's say, my department. Can you imagine that we have a 7-week course in this setup? So if you don't mind, I would really like, I will post it then on Canvas. Please, it will take you, I don't know, a minute or something, but it will help a lot to, keep this going. This is number one. And number two, has nothing to do with finance or work at all. The thing is this, so since we have the pandemic, nobody seems to be in touch with anybody else. So for 8 months, I have not seen or heard any of my colleagues, honestly. And the highlight of my job is usually spring and summer after the lecture, going on campus for beers, sitting in the sun with my students, just chatting, talking about all kind of trash. None of that is happening. So I feel like an important part of what I liked about my job is completely gone. And for 8 months, I hear more or less the same thing from students. I'm kind of lonely, I'm isolated, I do not meet anybody. So a couple of weeks ago, I spoke to SR and said, guys, is that your impression as well? So our student organization, our student representation. And we had last week a meeting and discussed this a little bit, and we said, okay, we are setting up together a pub quiz. It has nothing to do with finance. It's not even RSM or work related in any way. It's just because I miss basically hanging out and getting drunk with my students. So we are creating this. SR, student representation, has posted it on Facebook, on Instagram. So we have a WhatsApp group. Check it out if you wanna attend. It's going to be a pub quiz. We are going to live stream obviously from here. I already tell you, it's not my job, so I don't have to do this. I will get absolutely devastated. I promise you that. And we are working on questions that are very challenging that you cannot Google. And of course, the main idea is to get a bit drunk and have fun. So if you say you want to connect a little bit and just have a fun evening, look it up. Our student organization is called SR, Student Representation. So if you can immediately find this on Facebook, on Instagram, and of course I can post the link also in our WhatsApp group. So if you say you want to connect a little bit more and want to have 2 or 10 beers, this might be an event for you. Guys, thank you very much for your input, for attending, and for your interactivity. If you have no more questions, I see you on Friday this week in 2 days at 11 o'clock again. All right? Guys, have a good day.
Thank you.
You're most welcome, guys.
Thank you.
See you Friday.
Thank you very much.
Florian, I have a question that might just, it's not like finance related or anything.
Doesn't matter.
I remember you taught us, I'll just like, can you see me or not?
I cannot because the monitor is not turned towards me.
Then I won't turn on my camera, but
that's all right.
You taught us the macro course, and then when you published the results, you sent an email that said, if you have a grade above this and this high, please email me so you can get in touch. And I was just like, I emailed you, but I didn't get a response yet, so
I emailed just so everyone understands what's going on. So when we had the macro course, I sent an email to every student who scored a grade of more than 9, which is exceptional, saying, well, obviously that's unusual, it's really awesome. If you're interested in at some point working as teaching assistant or research assistant, send me a brief email, which many of you did, just so you know what I do with this. So I have no colleagues that teach in a bachelor. So you have to imagine that most of the finance faculty in the finance department, which is one of the biggest departments on campus, none of my colleagues actually know bachelor students. So very often my colleagues need teaching assistants too. So obviously I select my own teaching assistants, no problem. But my colleagues very often say, shit, I need 5 people, but I don't know any student that is talented that I can ask. And because they know that I have all the large courses and that I like talking to my students and that I know which student is good at what, I'm a bit like the human trafficker in the 8th floor. So the accounting department, as well as my own department, the finance department, frequently approach me and say, hey Flo, we need 3 people to help out with grading. Send us a couple of student names that we can approach. So what I have is, in my Outlook, I have a folder with your emails that you guys sent me in response to my email, and I'm forwarding that like a human trafficker. So my colleague Wolf Wagner, look him up, Wolf Wagner, he will teach the new micro-macro course in the new curriculum. He will need a ton of teaching assistants. He already has a list with all my macro students that replied to my email. So it's just very early in the academic year. That's why he has not approached you, but very likely he will. Okay, so that's what I'm doing.
Okay.
And of course, if I need,
Really nice, thanks.
yeah, and if I need assistance myself, so the moment you are in the 3rd year and I need assistance for my 2nd year course corporate, I will use you. The problem is I cannot use you as my assistant on a course that you are currently enrolled as a student yourself. I cannot ask you, I cannot say, I think you did a great job in macro, please help me grade corporate finance exam, which is an exam you yourself did, and half of the other students are your close friends. That's just fucked up. Okay? So,
Yeah, I understand.
So
I was just like, since I have you here, I was just wondering what you would do with those emails, because I would really like to do something more than with macro and microeconomics than just like the course.
I totally get it.
I'm not an expert in finance or accounting, so.
That's not necessary, right? So I typically need students to help me grade. And obviously, it's not that I give exams to students and say, yeah, good luck with that, whatever. So there's a very clear grading rubric, you know, if then else, if this, then X points. So it's never that you get thrown into something. That does not happen. But that's what I do with these emails. So I basically keep them in my separate folder. So when colleagues approach me, because also think from my perspective, I can help you in my own course. And if you're very interested, I can give you extra reading material, stuff like that. But it also makes sense at some point that you work with other people and learn from them. Otherwise, it's a bit like intellectual incest if you only hear my opinion on everything. So I try to basically pimp out my students to my colleagues. That's basically what's happening. So also don't be weirded out if at some point you get an email by Professor Wagner or any of the other hotshots. It does not mean you have done anything wrong. If anything, it means, well, you scored very well and therefore they would like to collaborate with you. Okay?
Thank you.
You're most welcome, guys.
Really nice, actually. Thank you.
Super. Yeah, cool. Happy to help. Guys, I see you on Friday. Enjoy the day. Thanks for attending. And please, when I post the survey, please fill it in. Like, comment, and subscribe. See you guys.
Florian, can you hear me?
Yeah. Yes, I can.
Yeah, I would just make use of this moment to thank you about how passionate you talk about accounting and stuff. I really appreciate it.
Thank you, man. Then just wait till you hear me talk about finance. This is nothing yet. This is just foreplay, all right? Thank you, guys.
Professor, I still have a question.
That's a question.